A golden moment for South Africa's metals, or just a glittering illusion? What do the latest market moves in commodities mean for the country? Hello, this is No Ordinary Wednesday, Investec's fortnightly podcast, where we try to make sense of the economic and business world that often feels it's moving at warp speed. I'm Jeremy Maggs. This week our attention turns to metals, markets and the business of trade. South Africa's fiscal fortunes, as we all know, are tied intimately to the performance of its commodity exports. A strong trade surplus can be a lifeline for the budget, but only if the country can get those goods to port. Cue Transnet, freight bottlenecks and the reality that we're leaving a lot of money on the table. At the same time, the global backdrop refuses to sit still. In the United States, inflation is proving sticky. Core personal consumption expenditures, or PCE inflation, is rising again, complicating the Federal Reserve's rate-cutting calculus. And trade tensions are resurfacing. While Washington's latest tariffs are hitting some metal exporters hard, South Africa's producers have so far been spared the heaviest blows. Could that reprieve prove an advantage? To help us understand these moves, I'm joined by Investec Investment Management experts, Osa Mazwai, an investment strategist, along with Campbell, Parry, a commodities and natural resources analyst. Osa Mazwai, Campbell, Parry, a warm welcome back to No Ordinary Wednesday. So, Osa, let me start with you. South Africa's fiscal position, as we know, is closely tied to commodity cycles, and we've recently seen a trade surplus and rising prices in precious metals and platinum group metals, or PGMs. But with persistent Transnet constraints, what does this mean, in your opinion, for longer-term fiscal planning?
Good morning, Jeremy, and thank you very much for having us this morning. There's two distinct points I'd like to make on this particular question. The first one relates to what we've seen historically when you have a significant rise in our trade balance, which is typically related to higher commodity prices. But then secondly, I'd like to talk specifically to what you've asked around Transnet. And the first thing I'd like to go into then is really related to what we saw in the previous commodity boom and the post-pandemic economic recovery. And what we did see there was the fiscus over that 2-year period collected around 200 billion additional in tax revenues. At this point in time, given the kind of rise we've seen in our trade balance, there are various estimates out there which indicate that the fiscus should collect around 40 billion additional tax revenue this year. And the important point around that is that we'll remember in budget 3.0, there was a line item around tax proposals, and there was additional policy measures over the next 2 years, which kind of are more or less in line with that 40 billion that we expect to collect extra due to rising commodity prices. So from a fiscal planning perspective, there has been that sort of alleviation from those fiscal pressures, but it does not completely take away from the potential of budget impasses into the future. And that then takes me into my second part of the question, was really around Transnet. And the key point is that we've seen a rise in commodity prices, but what South Africa is missing now is that volume uptick. And obviously then that is a missed opportunity from a fiscal collection perspective. We have heard at least some positive commentary from Minister Barbara Creecy of late around progress being made from a logistics perspective. But, this reform takes time at a time when South Africa doesn't have the time given the stagnant economic growth environment that we're in. And really then the point is that because of our logistics constraints, then it's really been a missed opportunity to collect more from a fiscal perspective.
So, Campbell, let me throw it to you. Investors have been watching gold and PGM stocks closely. How have South African resource stocks performed this year, and what, in your opinion, is driving those returns?
Yeah, hi, Jeremy, and good morning. Thanks for having me back. It's good to be here. So, if you look at the CAP-SWIX index as a proxy for the market this year, it's up around 23%. And of that contribution to return, 6 of the top 10 are resource companies, and all of them are precious metals companies, either gold or plats. And in fact, if you look at the top 10 absolute performers, 8 of them are gold or plat companies. So resource sector, it's 8 companies of the top 10, which is quite impressive, virtually unheard of. And as a gold bull myself, I'm actually delighted to see it. So it's been golden PGMs all the way this year. The gold price is up 30%, but the stocks are doubled. The PGM basket price is up 40%, but the stocks have more than doubled. In the case of gold, the gold shares globally have done very much the same thing because the sector at large is reporting an all-in sustaining cost margin of around $1,600 a ton, which is absolutely wonderful for cash flows. Almost all the companies are net cash at the moment, and we're seeing gold companies paying 3 or 4% dividend yields, and in fact, sometimes special divvies. So, that's virtually unheard of in the case of the gold sector. Moving over to plats, where the run has been more recent, I think it started back in April. The stocks have more than doubled on a basket price, up 40%, as I said earlier. And it's all happened because where at the start of the year we were expecting the PGM supply-demand balance to be in surplus this year, it's actually very quickly moved into deficit, given a very strong Chinese jewelry demand, strong Chinese demand for tighter emission standards, and some constraints on the supply side, some stresses on the supply side. So it's all good. But looking at both sectors, by and large, very similar performances to date from both the gold and PGM sector. And unfortunately, elsewhere, it's been quite quiet. If you look at the diversified miners, Sasol, for example, it's been quite quiet in terms of that contribution to return.
Also, as I mentioned in the introduction, PCE inflation in the United States is proving sticky. So why should South African policymakers and investors care? And how, I wonder, do those dynamics spill into aspects like trade balance and currency?
Well, it's worth highlighting that core PCE inflation is the US Fed's preferred gauge of inflation. And when you have this dynamic of sticky core PCE inflation, then that leads us to the question on the extent to which the US Fed can continue to cut interest rates, the depth of those interest rate cuts, and whether there can be monetary support for US economic activity and demand more holistically. Now, the precarious position as well that the Fed is in at this point in time is you're dealing with this sticky inflation or core PC inflation, and then the other balancing act is what happens in the economy. And of late, we've seen quite stark revisions to the non-farm payrolls data being downwardly revised, and it does potentially show some kinks within the US labor market. So then you ask the question, well, what does that mean for our trade balance and our currency? Well, firstly, from a trade balance perspective, we do need to be starkly aware of two things. Firstly, the US, through its tariff policy, is trying to reduce their trade deficit. That's the first thing, which should be negative for our exports, depending on how ultimately tariffs play out. And then the second point really being around how the US Fed continues to cut. They are expected to cut at their next meeting. That should provide some support to demand in the US, and that should be good for demand, firstly, but also could have a bit of an erosive impact on the full impact of tariffs. But as I've said, it is about seeing how tariffs ultimately settle.
Campbell, let's return to metals now, and beyond recent price gains, which metals or subsectors, in your opinion, look structurally well placed over the next, let's say, 3 to 5 years?
I'm not going to run away from gold too quickly at this point in time. I continue to see it as an important constituent of any portfolio. If you look at the world, we believe over that time frame, certainly it's going to remain an uncertain, nervous place. And I think inflation, as Osa just said, is probably going to stay high, or the bias is that it stays pretty high. And let's face it, the US deficit is structural and it's problematic, and that plays into the hands of gold. So I would stick with gold for the time being. But then if I look elsewhere, I've always been a bull on copper. I remain that way. I see higher prices gently emerging over the next couple of years as the world electrifies and as a supply base over the years has been grossly underinvested. So there's a supply-demand imbalance emerging for copper, which I think is hugely supportive of price over the time frame that you want me to talk about here. And finally, I think if I think elsewhere, it's not so much a metal, but thermal coal. I do expect to see some recovery in those prices. I mean, they're really rock bottom at the moment. And so many of the producers are making losses at the moment, which that is a situation that cannot persist. And Chinese production, which has been quite strong of late, which is been part of the reason why prices have come off. That production is now at risk given government inspections of many of the coal mines in China. So, thermal coal would be a third one that I'd add to that question.
Also, if the Federal Reserve, coming back to you, does cut by 25 basis points, and that is widely expected, what ripple effects then could that have on metals and South Africa's resource-driven economy? What's your thinking?
Well, that takes me to the point I made in the previous question when I said cutting interest rates does have the effect of influencing demand or overall demand dynamics in the US. But how does that impact the metals economy and South Africa's metals economy specifically? Well, I think the key point there is, we'll recall in the first round of tariff announcement, a basket of our metals were exempt from tariffs. And this is largely related to the fact that South Africa has both absolute and comparative and competitive advantages when it comes to our metals economy. And therefore, the US itself is not endowed to produce some of those key metals that are needed within their broader industrialization or manufacturing processes, etc. So ultimately what we're looking for is, how does tariffs ultimately settle, as I've mentioned, and really then the key point is that the US itself does not have the endowments to produce some of the metals that are produced in South Africa. And so you are sort of cushioned from the full effect of tariffs from that perspective. And then a 25 basis point cut can have the effect of stimulating demand, which should be good for our metals economy.
All right, we'll continue this conversation in just a moment with a closer look at South Africa's so-called Magnificent 10. But first, I'd like to remind you that a new episode of No Ordinary Wednesday drops every fortnight. Please don't miss it. Subscribe to Investec Focus Radio SA wherever you get your podcasts. And if you like the channel, please take a moment to rate us. Campbell, Parry, back to you. And South Africa's so-called Magnificent 10 stocks have been carrying the market for this year. Let me ask you if this is genuine strength or simply a case of investors crowding into what could be perceived as a safe corner.
Yeah, Jeremy, I think it's actually a bit of both. There's genuine reasons why gold and plats have been so strong, and it's attracted investor interest through and through. I mean, gold that just touched 3,500 today, as you said. That's really good for cash flows in the business, very good for balance sheet strength, and very good for prospective shareholder returns. So that's what's attracted shareholders and investors. I think the gold price remains fundamentally well supported, and it's a similar thing for PGMs. We've moved from surpluses to deficits in all three main PGMs. In fact, the best performing PGM this year has been ruthenium, which is something we're going to talk about. But be that as it may, we've got deficits in actually the top four PGMs. So that is a situation that's expected to persist. And as I said, it's a combination of genuine strength and investors seeking some safe havens.
And also, just before we get to you, just a quick note that we are recording this conversation on the morning of Tuesday, the 2nd of September. So also, with precious metals then propping up the trade balance, how much real breathing space, in your opinion, does this give Treasury? And is it anything more than just perhaps a temporary reprieve?
I'd like to answer this question and link it back to the answers that Campbell just referred to when you asked the question around, is this genuine strength? And at this point in time, we can certainly say that it gives some breathing space to National Treasury. I did mention earlier that some estimates say that we might collect 40 billion extra from a tax collection perspective, and then that does give us space at this point in time. What is of more significance, perhaps, is how geared South Africa's economic performance is to cyclical trends globally. And I think that, of course, National Treasury's revenue collection, as we've seen, is better in an environment where commodity prices are elevated. And of course, the opposite would be true when you have downward pressure on commodity prices. But as I think Campbell mentioned, that at this point in time, when you're looking at the performance of the stocks, looking at the performance of commodity prices in general, the gold trends, and as far as central banks buying is concerned, it does seem to be a bit more of a genuine strength story. But of course, we do want to keep an eye out on the overall reform project, and the volume uptick is what we fundamentally need to come through so that even in the event of lower commodity prices, then you have that volume perspective, which would then certainly have the effect of holding up the trade balance, or at least mitigating against more downward pressure in an environment of potential weaker commodity prices.
Campbell, let me put a kind of a sentiment or perception question to you. Against a backdrop of stubborn US inflation and an uncertain recovery in China, I'm interested to know how global investors are then viewing South Africa as maybe a differentiated play or just another part of the so-called emerging market pack.
I think South Africa, unfortunately, is a smaller and smaller part of a larger and larger pie. And it's not because there's something wrong with us. In fact, our markets performed okay, and it's been concentrated in a handful of stocks, but by and large, the performance has been okay. But if you look at China and Taiwan, part of the emerging markets index are 50% of the emerging markets index. I think India's coming through strongly. I think India's underrepresented in the EM index given the size of its economy. You look at places like Indonesia, 200 million people growing at 6%. Malaysia, Vietnam, other frontier markets, these are just growing and growing and growing compared to South Africa. It's quite tough for South Africa to be in any different position given the growth rate differentials. In order to cater to that, you need return on invested capital north of 15, perhaps 20% in order to attract foreigners. So unfortunately, we are a bit of a fading market in EM, I have to be honest. And it doesn't help that our regulatory and legislative backdrop is not conducive to profits in this country. And it certainly doesn't help having crime and corruption, which is also an impediment to optimal performance from our resources sector.
Also, beyond the United States, China's uneven industrial recovery and also India's growth story, I imagine, are shaping metals demand. When you add robust US retail sales into the mix, maybe just give us a sense of what the global demand picture looks like for South African exporters.
It has become inherently difficult to forecast global demand dynamics this year, and we've seen multiple revisions to the global growth outlook for 2025. And this has largely been driven by tariff policy coming out of the US and what could be the overall impact on inflation globally, because tariffs are expected to have an inflationary impact as well as having a downward or negative impact on growth dynamics. So I think that from that perspective, then the key point is that it's inherently difficult, but at this point, global growth is expected to be at around 2.8 and 3%, depending on what estimates you look at. And I think towards the tail end of last year, global growth was expected to be around 3.3%. So that's sort of a material downward revision to global growth for this year. But then, of course, you've touched on the US retail sales data that we've seen of late. I think the latest real retail sales data saw a slight uptick. But I think that there's an important nuance to pick up in that uptick in the real retail sales number, that increased in an environment where inflation has been increasing. And what that means is that the nominal retail sales number has been on the uptick as well. What is important for us to disaggregate at this point in time is whether that is demand driven or supply driven. And of course, due to the tariff policy, then it's more likely that the impact on increasing nominal values from a retail sales perspective could likely be driven by tariffs. And over the next couple of months, we will continue to monitor how tariffs play out in the prices of goods in the US, and then, of course, then how that filters through in the rest of the economy.
All right, gentlemen, let's start bringing this conversation to a close and maybe with a forward look. And also, let's continue with you. Will South Africa's commodity-driven trade balance continue, in your opinion, to support fiscal stability, or does government need to find resilience elsewhere? What's your thinking?
I think like any economy, a diverse mix of economic activity is always a good thing, because that does cushion the economy for any other kind of cyclical dynamics which can have a negative impact. And we do know that South Africa does have a diverse economy. We've got a robust financial services sector, you've got robust trade sectors, etc. But I think that the most important point is that for South Africa to be resilient or to be cushioned against against volatile commodity prices is, again, dealing with the structural constraints facing the economy. We do need to deal with economic policy, ensuring that economic policy is supportive of business confidence so that we do attract foreign direct investment and we do ultimately end up in a situation of decoupling from this stagnant growth environment that we've seen over the last 15 years. 1% growth is just simply not good enough. We do need to see growth tracking towards that 2% level and higher. And then we would like to also see greater monetary policy support within the South African economy, as we've seen of late, inflation really being at the bottom end of the inflation target range. As we get greater clarity on what the inflation target would look like, then we would like to see rates become less restrictive than they are currently.
And Campbell, finally to you, and given your earlier remarks, I suspect I know what your answer is going to be, but for investors, do resources remain the right place to be, or is it time to maybe rotate to the next story?
Jeremy, you're talking to the wrong person here. I'm an out-and-out raging commodities bull, and I sometimes think that the run we've seen in golds and plats recently is just a foretaste of what's to come elsewhere in commodities. And over the medium term, that's because we have a view that as the world fragments and deglobalizes, there's going to be more emphasis placed by governments of the world on securing the commodities that they need for infrastructure spending, for defense spending, for energy security, and for what we call tech sovereignty, so AI, data centers, electric vehicles, and that sort of thing. So that's a comment more broadly about commodities, but I think in the meantime, I still like gold. I think resources is a good place to be. I've said that I still like gold. I like some of the higher quality PGM names, although I do see some consolidation in the sector in the near term. And then finally, we have just started looking now at some of the South African diversified mining resource plays, which I think are really cheap and offer prospective shareholder returns, which are often look eye-watering. So that's very attractive. And so that's my view on commodities generally.
Well, what a fascinating conversation. Osa Mazwai, Campbell, Parry, thank you both for your insights. And as always, if you enjoyed this episode, please follow Investec Focus Radio SA wherever you get your podcasts. We will be back in a fortnight with more analysis on major economic trends shaping our markets. Until then, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.